Okay, so moving average is something very similar. Moving average is a simple technical tool that smooths out the price data by creating a constant update average price. The average is taken over a specific period of time, like let's say 10 days, 20 days, 30 days, or weeks or months, whatever the way you are looking at it. And the most common use of MA is to identify the trend and determine the support and resistance. Okay, that is a very simple use of moving average. It eliminates a lot of noise also around your charts, around the price movement. Now, what you see on the screen is, can any one of you tell me what are these two lines?
Price line and moving average.
Okay. So yeah, looks like that, but this is not the price line. This is an extreme short-term average line.
Yeah, short-term and long-term average line maybe.
Yeah, so by just seeing this, you know exactly what is the short-term trend, right? And this is a long-term trend. This is a 200-day average. So you know even it, you know the longer-term trend also is trending. Not very strong yet, but it is. This is nothing but the 8-day simple average. By just looking at the line, one can say in the short term, medium term, and long term, where is the stock or the market headed? As simple as that, right? Just by looking at it. So I've just removed the price from here just to show you guys the average. Now this is 8 and I'll just add 20 and 50 also to it. So now I generally give 4 different colors: red, blue, green, yellow. So red being the shortest term, 20 is your blue, 50 day is your green, and yellow. So you know that in this particular chart right now, all of them are trending from all time perspective. There is enough clarity on the trend. Now we know for the last few days market has been volatile, but by looking at it, can one say the market has been volatile or market was weak for the last few days? So when you remove the price and you just look at the short-term average, it eliminates a lot of noise around it, right? You know that even the short term is actually not bad. It has just turned negative right now. But had you seen it here, it was falling. But did anyone of us, by just seeing the averages, would we realize that there was something wrong in the market? It is only when this turned is when we started realizing on based on the average. So just see how averages eliminate a lot of noise around the price movements in the short term as well. Forget about long term. Now, how we look at you know, the ways we generally tend to use averages are basically to see the trends. Apart from that, averages are used to use it for stop losses. There are people who use price over moving average for buying or selling, or a crossover of average over another average for a crossover to buy or sell a stock or the index or exit the market overall. And finally, it also talks about divergences and convergences, which we'll all cover in today's topic. Now, there are typically 4 types of averages. One is a simple average. The simple average is, this is right in front of us. It is the closing price of X number of days of the moving average that you're seeing by that. Next is exponential. Exponential is nothing but it gives a little more weightage to the near-term price closures than you know, the entire time frame that we look at. So it is a little more sensitive compared to your simple average. Then you have weighted averages, and then you have adaptive averages. So there are 4 different kind of averages. The most common ones are your simple and your exponential. Over here, I have Nifty, and I have the same time frame averages. This one on the left is your simple average. The one on your right is exponential. If you just see, what differences do you see? How exponential has reacted faster than the simple average. It is only because it gives more weightage to the recent closures than the entire average that time frame you're taking off for. So it has already reacted negatively or flat to the price already on the 20th itself, while on simple average it had taken on the 26th, almost 6 days later. So this is much sensitive to the simple average. But also if you see how smoother it is versus the simple average, the exponential average. Now by just seeing the trends, you will identify that exponential average is giving you indications way in advance. Sometimes it gives you a little later because it is eliminating a lot of noise around it, right? So these are the two averages that most of the people use. Now, which averages to use is the question. Each person has his own choice of averages. I use 8, 20, 50, 200. The people who like using 5, 8, 21, 34, 50. So those are Fibonacci numbers. So they want to use those. So each one has his own. Like I also use a 30-week average on a weekly chart. But the idea is to have averages on your chart, which talks about short term, medium term, and long term. Couple of days here there doesn't really matter when you're actually utilizing that from identifying the trend. Between a 20 and 21, there will be not much of a change. But it is when you are actually using it for just purpose of trends or stop losses, that one day will not matter much. But to each his own. So which average you use is your personal choice. Now, when you want to utilize an average to see the trend, if you look at, if I have to just zoom out, by seeing this since almost 21, Nifty on a 200-day average has been trending, barring a couple of weeks in between. So we know the longer term trend is strong. Now in this, there'll be lots of ups and downs in between. Okay. And when you look at it this way, the market has not been that bad, barring a few sessions in between. But we know how this has played out on the market, the fall over the last 1.5 years. If you add the prices or the candles to it, is when you actually see how much of volatility or correction has been there. But when you look at only the averages perspective, you know that there is nothing wrong with the Indian markets for a very long time. It has been trending. So if you want to eliminate noise in your portfolio, just look at averages and you'll know exactly where you stand. If you are a trader, you want to book your profits and re-enter later, you look at a short-term average. If you are a long-term investor, you would look for 200-day average, and when the market or the stock closes below 200-day average, you would want to exit that because then it is not strong. And when it goes and closes above 200-day average, you know that okay, the strength is building back in that, and you can enter the stock or the index and continue to trade in that for a longer bullish run from there. Now, short-term traders, let me just add the price here. Now, this is the candlestick along with that. Now, what do short-term traders do? Let's say this is a 20-day average. The market was falling. When the price crosses 20-day average, they would want to initiate the trades over here. And then they ride the rally up, and they would use a 20-day average on a closing basis to trigger the stop loss, trail the stop loss going forward. So this is one way a lot of people use a moving average, that you would have taken on a crossover of a particular average that you are comfortable with. In most cases, it is a 20-day average. And when the stock or the index closes about 20-day average after a fall is when you initiate a trade. Also, please note that whoever has missed or they have exited or they want to re-enter or add more of a particular stock, they will do it when the price comes and takes support of the 20-day average again. If it has not closed below the 20-day average, it is an option for you to add more over here. So someone who had entered over here wants to add more or had exited on this candle can buy back over here on the 20-day average again, right? And then they're riding the rally up again. Here, it did not close below it. Otherwise, the stop loss would have got triggered. On reversals, they can add more. A fresh entry can be taken again. And finally, yesterday, when it took support of 20-day average, you have an opportunity to buy again if this sustains in the next few days. So this is how very simply people use averages to initiate a trade or use it as a stop loss. You may have taken entry on a 20-day average, but you are a long-term trader. So you would actually want to use a 50-day average as your stop loss. You want to avoid the smaller swings in between, which would be there for a couple of days. So let's say I have initiated my trade over here at 17,222. I know the market is going to trend and I don't want to exit in this time over here. I know there has to be some correction that is there. So I will use my 50-day average as a stop loss. Now, that is because I'm not a very short-term trader. I'm a more a positional trader. So if 50-day average is broken, that's when I would like to exit the stock or book my profit and stay calm and watch for an option to re-enter again. So depending on the kind of trader you are, is the average you would use as a stop loss. Now, another very good use of averages is, apart from price crossover, is a moving average crossover of another moving average. A short-term trader, apart from a price crossover, would want to use, let's say, a 8-day average over a 20-day average. When a short-term average is crossing over a little higher time average, that crossover is also an option or indication for someone to buy. So here 8 has crossed over 20 at this candle. So someone who's not bought it here would want to start buying over here. So depending on, again, the kind of trader you are, whether you're short-term or longer-term trader, you can use a crossover of an average to buy or sell. If you are a short seller, you would want to sell when a 50-day average a 20-day average crosses over an 8-day average. So basically, it only means it is starting to go down. In this case over here, if 8 days average starts going below the 20-day average, someone would want to initiate a trade, a sell call over there, because from there the profit booking is going to happen. A few hundred points downside will be seen. So there's another very good crossover that is called a golden crossover and a death crossover. A golden crossover and a death crossover is extremely important to define the longer term trend of a stock. When I say longer term, I'm not talking about years, but next few months or quarters or next entire rally. So whenever a 50-day average crosses a 200-day average, is called a golden crossover. Now over here, let me just remove the first two. Now you have a 50-day average crossing a 200-day average over here, right? Now this is a point where the market is turning bullish and you initiate your overall portfolio into the market, you start buying. From here, the negatives are eliminated and the trend is going to be strong. Okay, your risk reward is very apt from here. So whenever there's a golden crossover, you can start building a larger portfolio for yourself because the worst is behind you. And then you ride the whole rally up. Likewise, a death crossover is nothing but a 200-day average crossing over a 50-day average. It is called death crossover because it has been seen very often that the market goes in a long-term bearish phase whenever that happens. Not necessarily every time, but more often it happens. Like there was a death crossover over here, but the market did not react. So we had given an explanation for this also, because when you look at past trends, it gives you an indication whether the death crossover is actually working the way it should be, or it is just a fake death crossover. Now look at this. This was a golden crossover. It just corrected, but from there the rally was strong. But nowhere the death crossover failed later. Now this was a death crossover. So when this death crossover happened, if anyone would have gone short over here, they would have got benefit of the entire fall. So death crossovers and golden crossovers are very, very important for a longer term portfolio. Now, after the pandemic fall happened, when the golden crossover happened, when we saw the crossover over here, it was around 11,000. Already market had moved up around 4,000 points from there. But this was a confirmation that now the negatives are out, it is behind you, and the market is going to trend. Just see how beautifully the market has trended. Now, until 22, was there a reason for anyone to not, book their profits? Like just not exit the market? Market were trending, you would have ridden a good rally up. There was no reason for anyone to worry, even if these small, profit bookings in between were seen. The longer term, if you were not leveraged, you would have held on to your positions very comfortably, eliminating all the noise around, the market, whatever was coming at that time. Now, traders obviously want to play in these swings also. But please understand that this was a clear indication that now, at least for the next few months, there is no reason for you to worry about the overall market. Now, the third thing that I want to talk about is deviations. Now, when we had spoken about RSI, we had also spoken about deviations or divergences and all that. What we also, when we did patterns, we did channels, we said that, market moves in a particular pattern, there is an average and it has to play between that. Whenever it deviates too much, it hits the upper trend line, that is the resistance, it will in the next wave fall, test either your average or the lower channel line and move back up, right? It is likewise for averages also. Market or the price moves generally in line with the averages. Every time it deviates too far away from the averages, it tends to correct and come back to test the averages and then move back up. This correction is very important in the long term because the price cannot keep going up against the averages all the time. It is very important for it to constantly keep coming back, testing the averages and then going up. That is the whole purpose of the average itself, right? Now, not only in prices, look at things around you. Let's say the weather itself, when the average weather during summer is supposed to be, let's say 39 degrees in the place where I am, and the weather, in fact, it goes up to 40 to 43 degrees for 1 week. It is deviating away from the average. Eventually, what happens? It cools down a little for a couple of days. There may be a light shower also. The temperature comes back to 39 degrees and then remains there, and maybe it'll move back up again. So anything and everything around us, it cannot just go one way. It tends to come back to the averages of that particular thing over a period of time. Now, when the market is strong, it generally tends to only test the short-term averages. Reversals of the market after testing short-term averages only means that the trend is very strong. Like when we talk about RSI, when we know RSI is trending, when I say the car is on the highway, you know that there is nothing wrong with it. There'll be a small slowdown, consolidation, and move up. So whenever the average is testing only the short-term averages and moving back up, it is only meaning that it is a very strong trend. But when it breaks the short-term averages and tests the medium-term averages like the 50-day average, that's when one needs to understand that, okay, things are not that bad, but there is some kind of a slowdown. Now you'll have to wait for a couple of weeks or months for things to settle and get back again into a fresh rally. So whenever it is deviated too much from the medium-term averages, it tends to also correct back to the medium-term averages. By the way, another reason why I use 50-day average is also because 50-day is generally a 3 months average. You have about 20 trading sessions in a month. So 60 trading sessions in a quarter, plus over and above that you have holidays. So typically 50-day average is also a quarterly average. So you know the stock is or the price is deviating too much away from a quarterly average. It will somewhere consolidate or fall and test the averages. Now to test the average, it is not necessary the price will fall. Corrections are of two types. Correction is time correction. Correction is a price correction. To test the average or come at par with the averages, either there will be a big fall to the average and then it will reverse, or it will consolidate in the range where your averages tend to move towards the price itself. So, or it can be a combination of both. Now, whenever you see in the past, whenever the market deviates too much, let's go back into the history. Whenever it deviates too much from the 20-day average, it tends to test. It very often tests, closes 1 or 2 days below, and then moves back up. This is where a lot of negativity comes around, but that doesn't hold. The breakdown fails and it tends to move up. So when you use exponential averages, a lot of the noise around all these things can get eliminated. Or if you're using adaptive averages, the adaptive average will not show any negative in these kind of volatility. So the trend will continue to be strong. So you need to identify the right average that you are comfortable with for this purpose. But now look at it, whenever it is deviating too much from 50-day average also, it comes close to 50-day average, probably give a false breakdown and moves back up. Whenever it deviates too much from the 200-day average, now 200-day average is typically a 1-year average. In a year, there are 365 days. There are 52 weekends, so 108, you have, non-trading days there itself. Plus you have other, holidays. So on an average, you have about 200 to 220 trading days in a year. So 200 days is typically an annual average. So whenever the price deviates too much from a 200-day average, please understand it cannot go up one way, it has to correct. Now this correction may be led by any news that is coming globally or internal, domestic news, economic news, whatever may be. But please understand, when the market requires a correction, the news will automatically follow. Okay, it does not mean the market was strong and the news made it fall. The fall at that time was needed. And the news, whatever comes at that time, is what triggers the fall. Now look at this. Deviates too much, it falls. And it sometimes happens to close below 200-day average for a couple of months also. Now this is a time where one needs to avoid buying. You may be a trader, you would want to trade, but it is an avoidable market. Long-term investors can find a value buying over here, but they need to be careful, because this fall below the 200-day average can remain for very long. Like if you see in case of Reliance, it has happened for almost 8 years. So stock like Reliance also consolidated for 8 years. So your averages give you a lot of information as to where the stock is headed and where you should wait for a breakout to happen and buy. So this is one thing that I want to talk about, is divergence. Now, the last thing I want to talk about is convergences. Now, moving average is a beautiful tool to identify breakout and breakdowns also, right? So whenever a lot of averages, sorry, your short term, mid term, long term averages converge, they come narrower together, and they all coincide with one or two candles, it only means there is an extreme consolidation that is happening, and then there will be a breakout either side. You need to start watching for that breakout. Like your Bollinger Bands, when it narrows down, it gets narrower, and then there's a breakout, it opens up. If you're not using a Bollinger Band, your moving average also gives you a similar indication. Now over here, if you have to see the way all averages are converging over here, your midterm, including your 200-day average, it just shows how beautifully the market was consolidating. This would be the time when your RSIs would be between 40 and 60. This would be the time where your Bollinger Band is extremely narrow. And this is the time where traders get frustrated the most, because the stocks don't move. But one candle over there is enough for you to point out that, okay, the market is now breaking out. And from there is going to be a very strong trend. This candle is over here where you see all the convergences were happening. Now, there can be a convergence of just 2 averages also. There can be convergence of 4 or 5 averages also. The more number of averages that converge is a very strong consolidation. So when you scan for stocks, look for more number of averages converging along with the candle. And when then there is a breakout, that's when this gives you a confirmation. You can initiate your trade, and then the market will rally. So whether it's an index or it is your stock, look for convergences. Now the market fall happened. How the falls are very quick, but look at the divergences from the average. Now, even if things didn't turn or improve, this pullback was needed to come and test to the averages. And maybe if things had not improved after pandemic, this fall would have continued. But this pullback to come back to the averages was needed. Irrespective of the news, irrespective of what the positivity it is, this pullback will happen. Then it breaks out, it tests a 200-day average again and moves back up. So these divergences and convergences are very important. So you can utilize your moving averages for this purpose. Now, please also note a lot of other indicators also coincide along with averages. Like, give you an example of yesterday. Yesterday, RSI at 60 was a support. It coincidentally also happened along with the 20-day average. So whenever market takes support of any one particular indicator, it very often happens that there's another indicator also supporting that. So the more number of indicators supporting that will only make it a stronger reversal point. Now let's just take a couple of examples from here. I'll just show you. Now this is ITC. Look at the convergence that was happening. Look at this point, how the convergence broke out and how the rally, after the whole noise around it, how beautifully it started trending. So these consolidation and these convergences are very, very important for trading. Over here, there was all convergences that was happening. 200-day was taking support, but one candle after all short-term and medium-term averages converging, it breaks out. It keeps taking support of 8 and 20 and 50, but it is a very strong breakout point. From there, the rally continues. So these are trigger points for the market to basically give you a beautiful entry. Now look at Tata Motors. So there was a lot of noise around its costings and interest cost and input cost and all that going up, and XYZ noise. JLR sales at that time had fallen again. So people thought that whole rally of Tata Motors had ended. The convergence, one candle breakout was enough. Just look at the way how all the averages broke out and they started moving up. Look at the direction of the averages. It just talks about the trend of Tata Motors from that point in time. Till now, it is trending. Now you think the stock is weak. And all this confusion over here is just this one candle was needed for it to break out and rally. So this is how one can utilize all the averages to identify. Now,
Mayur, I have a question in this chart.
uh,
If we go with convergence at the buy level, suppose it's 415. If we are bought at that price, and now we are at 635. What should be the stop loss we should be looking at if we are going to exit it if it comes down?
so
Just
below
an example I'm asking. Which EMA or SMA we should follow for the stop loss? Like
when it's a candle breakout, first of all, use that candle low itself if you want to. Because
if
it's a bullish candle
it's a long,
this candle fails, then you will have to exit.
if it's a long term one, I'm asking, like
Okay,
if
then
we are
there is
holding
no
it,
choice. If you're a long-term player, you would want to use a 50-day average.
then we have to exit around 494. You are telling
Somewhere here. If you talk about currently 581.
581. Okay, that
Okay,
should be the stop loss if we have entered at 420 now.
Yeah, because see this fall over here, if you're a long-term person, you would want to ignore this.
Okay. 50-day average, you
Let's
are
say you're
telling
buying
like
an
that's
equity. Let's say you're buying an equity, you have been a part of this rally. Okay, you know it's going to come to 581. You book your profit. The amount of tax you are going to pay of 12.5%, that is the fall over here. You don't have any benefit of booking out and re-entering. Okay, so please consider that. Okay, now you are a short-term trader. You don't want to miss out on your profits. You are very particular about holding your profits. You can use your 20-day EMA as your stop loss. Look, it has not broken 20-day EMA.
Yeah, that's what I'm asking. Like if it breaks the 20-day EMA, that
it all depends on the kind of trader you are. Honestly.
Okay.
Also, you can do is book part profit which breaks 20 EMA and then hold for the rest for 50 EMA. You can add back over there.
Okay. Fine.
So everything is to each his own. There's no particular concept or way one can, play around with it. Whatever gives you comfort.
Yeah.
Okay. So let's look at a couple of other stocks, with these averages that I have. I just want to show you a couple of things. Now you see the noise over here and you see how by looking at it, the average itself, you know that it is trending, right? Now, if you open any of the recommendations given to you guys over the last few weeks, all the stocks that we hold, the chart would be more or less trending like this. Barring the 8-day average, which keeps going up and down, the medium and long-term the trends are like this. This gives you enough comfort, right? There is no confusion by looking at it. There is nothing to worry about by just looking at it in your mind, right? Now, I'll just show you couple of stocks. Tell me, how do you feel looking at these averages? I've not even put the price right now. I've just have the averages. Now, if Kotak Bank was not written and I had given you this particular chart with all the trends going up and down, what would be your first reaction to this?
A big no.
A big no, right? Now, if someone comes and tells me how was Kotak Bank, what do I tell them? Just look at the averages. It'll give you clear indication where it is headed. Let me add that candle back. Whenever it is converging, if it is converging, then if you are still interested in a Kotak Bank, watch it on a daily basis. Whenever you come across a candle which is converging, mark it, and that's when you enter. Until then, it is a completely avoidable stock. You don't even have to look at it. This is your HDFC Bank. Your short term, medium term are very confusing, though long term trend is intact. So anyone who's a short term trader or medium term trader is stuck in it's very clearly not comfortable to trade in HDFC Bank because the averages speak itself that they're not trending. Averages clear point out to extreme volatility in it. Versus that, if you look at ICICI Bank, how is it? How much of noise is eliminated? It is trending, except the short-term average 8-day, which obviously is a little profit booking was seen and now back to trending. So when we say that we prefer an ICICI over an HDFC, even if you're not looking at an average, we know exactly by looking at the movement itself that where the averages would be. This is why we prefer momentum stocks over any other stock. A lot of people's favorite. Now, forget the price chart. Looking at the average, do you think you want to be a part of it? Versus that. Until the recent fall, wasn't as trending better than Infosys? So when we say that we prefer Tech Mahindra over Infosys is only because how beautifully a stock is trending. Even today, 200 days is now going flat, but overall it is all good.
Show HCL also.
HCL also I'll show.
We never kind of preferred HCL just because the noise is in this.
Now, another people's favorite, Bajaj Finance. When I zoom out of Bajaj Finance, just look at the swings of Bajaj Finance. It clearly shows that the swings are massive. It is in this range. Even the 200-day average has been swinging a lot. The swings of 200-day is very drastic. Look at the number of times the price has gone below 200-day average in the last 2 years. A trending stock would not. When it was trending, it hardly went below 200-day. This is a time where if you're very confident about a stock, you may want to accumulate for longer term. But from trading perspective, these are very difficult for traders because your stop losses get triggered very often. Now your Adani Enterprises is converging.
Yeah, it's converging.
Now versus that,
So I think at this juncture, we really like the setup of Adani Port and Enterprise. It may give breakout anytime.
okay. Now we'll look at certain more stocks. We saw DLF. After all the noise around DLF, over here, one after a consolidation or a fall, one candle, it with volumes. Look at the way the stocks are trending. Okay, there's one of 2020 also. This was another convergence points of DLF. It was consolidating, all the averages were coming together. Okay, it kind of broke out, it failed, again moved back up, but a very strong trend from there. Convergence of three, a breakout, consolidate, move up. You'll see a lot of these, and you'll also see a lot of breakdowns also. It's not necessary every convergence has a breakout. A lot of convergences have a breakdown also.
MLM recently gave a breakdown.
Now you have gold, 3 bars converging right now. It is not too deviated from your 200-day, it has corrected. So it is quite close to your 200-day also. And then it is a 3-bar convergence. So just before we started, we were talking about US oil. All averages converging, and there's a nice buildup that is happening, and a weekly close at 80. Now above 81, you can see 83.5. And then the rally will start. This will start trending again. All the averages will start trending again. Now, if this holds above 83, 84, you can just imagine how all the averages on a weekly also will start trending. Does this mean we are going to look at oil back to 120?
But there is no false this thing in this convergence.
There is
Every time.
100%. There's a failure everywhere.
Okay.
Okay, no pattern is 100% foolproof. That is why I say that on confirmation, buy as it moves up, as it gets stronger. So the failure has to happen in the next 1 or 2 days. But if the price holds, then it is confirmed. And that's when you keep adding.
Okay.
If you are playing for a 10% upside, you can't always be a part of 10%. But if you're part of 6-7%, you are among the 99% successful traders.
Yeah.
Now I wanted to show you CNX media. Now media में all mid, short, long-term averages are converging with 1 month candle. Now this is the July candle. You have one more trading day to go in this. If this candle closes at this point, then the media sector is on the verge of a breakout, long-term breakout. This is where media is today,
Okay.
right? This is PSU Bank, but media candle is like this right now. So how it trends? So media can trend. I have been ignoring media because for some reason I have not been fond of most of the stocks in media. They are high debt stocks, but it can be a turnaround story. So it does not mean that I want to jump into that sector right now with all my money. I will watch over the next few months. The buildup will be very big. It's going to go up a lot. So I am not in a hurry to build up on media at all. Let it hold, let it sustain. We'll look into it.
How does this work on a 15-minute time frame, Mayur?
Every time frame it works. Now look at Aisha Motors. The weekly chart never ever tested 200-day EMA until for almost about a good 10 years. Even if you see the daily, back then, from 2009 onwards, it was trending. So the swings in between do bother because they are there often for a couple of weeks or months. But when a chart is strong, look at the breakout point that would have happened over here. The convergence breakout at this point, it is a very tiny candle that showed the turnaround of a stock. At this juncture over here, now if I keep this chart, would any one of us look at Aisha Motors from a long-term perspective? What would be our reaction seeing this chart? Okay, go. Yeah, this was the breakout point. One convergence and breakout. This is the rally that you got. So convergences along with the candle is very, very important. It may not play like this in a lot of stocks. It may just play this much. But isn't this good enough for us to trade? And when the averages are trending, you know there is nothing to worry. The long-term trend is strong. So now which average to use is up to you. It is up to your comfort. Which average to use as your stop loss is up to you, your comfort. You may use the Fibonacci sequence ke numbers or series numbers as your averages. You may use what I use. You may use exponential or simple, that's your choice. But a 20, 50, 200-day average are very, very important. Do not ignore the 20 and 50 days, especially for traders. We are not long-term investors. So just keep that in mind. Any questions around moving averages?